Hello everyone, welcome to this week's video where I'm going to be diving into an introduction to the DOM or depth of market order flow tool. Okay, if you haven't done so, make sure to hit that subscribe, hit that thumbs up, leave any comments down below. So right here on the left side, you can see that I have a DOM. This is also known as a price ladder. So if you hear that term, depth of market DOM or price ladder, is basically the same thing. And you can see basically it's called a ladder because you have whatever instrument you're looking at, you have the price, and then you have every price level for that instrument over there. So basically that's where that name comes from. Okay. This is the simplest kind of DOM that you can have, where you have 3 columns, okay? And what we're gonna have here, you can arrange them. There's people that arrange them in different ways. This is how I like to have it, where I have the price is going to be in the middle. Okay, in this case, this is the ES futures market, the S&P market. So every price level that you see here is going to be 1 tick. Okay, 1 tick is going to be the minimum price multiple that you're going to have on that particular instrument. So in ES and NASDAQ, 0.25 is going to be the smallest unit of measurement of price, and that is called 1 tick. So 4 ticks make up 1 point. Okay, so here again we have price in the center, and then you're going to notice we have numbers on the left side below where the current price is, and on the right side above where the current price is, which is marked here. I have it set so it always stays in the middle, okay? So all the numbers that you see on the bottom left, this is going to be our bid column, okay? The bid column is going to show us all the limit orders to buy. Obviously, all these orders are going to be below where price is, because if you're going to try to buy, you're always going to be trying to buy at a lower price than where price is currently sitting. Okay, these are what we're going to call passive market participants. This is passive buyers that are sitting there with their orders waiting to get filled at all the different price levels. Right now, I'm recording this during the Asia session, so you can see there's not a whole lot of orders sitting here. If you look at this during regular market hours in New York, you're sometimes going to have hundreds of orders at every price level. Right now, the average is probably like 30, 35 orders on average, okay? And then on the top right side, we're going to have the ask, also known as the offer, okay? This is going to be the passive market sellers. This is going to be limit orders waiting to be filled to get short or to sell, okay? Now, remember, markets always need aggressive and passive participants. All the passive participants are going to be using limit orders, which we're going to be able to track here on the DOM, and all the aggressive market participants are going to be executed using market orders. Okay? Now, when you hear the term liquidity, what do we mean by liquidity? Liquidity means how deep or how many orders we have on the DOM or on the different price levels. For a market like ES, this is considered to be a very deep, very high volume market. So you're going to have a significant amount of orders at every price level. Whereas if you look at a cryptocurrency that's not very well known, or of some unknown obscure market, you're going to have a DOM that's going to be a lot less filled. For example, something like this is just an example that I made up of a very thin market, where you can see that you're going to be having just sporadic orders with not a lot of resting liquidity at all the price levels. And now, going back to the market participants, if we only had a market with passive participants, basically it would not move at all, because all these orders up here are waiting for price to come and fill them. And the same thing here. Or these buy orders down below are waiting for price to push below and fill them in on their orders. Unless we have traders that are willing to execute using market orders to pair up, either pay up, or what we call lift the offer, basically pay up, and in order to just get short, they're willing to just get filled at higher prices in order to just get an immediate fill in order to get short. Same thing in opposite would be to buy, okay? If we have someone that just wants to get in long, then they're going to place just a market buy order to get filled at whatever the next available level it is, depending on what size they are using. But they're gonna be willing to hit the bid, basically pay down, in order to get immediately filled at the next available price level. Especially when we're talking about the futures market, for me, that is the best market for order flow trading, because all the volume data is coming from one single exchange, which would be the CME. So you get very accurate volume readings, and no matter where you are in the world, you're going to be looking at the exact same data. Okay, so this is the most simple form of a DOM, as I said. We have other options here. Let me bring in. This is another DOM. It's basically the same DOM, but I've added some columns and some extra data on this, okay? So for example, this one, we have the price, we have the limit orders to buy, limit orders to sell on the ask or the offer, limit orders to buy on the bid, and then here I have the recent bid and recent ask. This just shows recent market order executions at different price levels. Obviously, like I said, the numbers are very low because we are in the Asia session, so there's not a lot of movement right now. And then next to that, I have this columns, which is what we call pulling and stacking. Okay, pulling and stacking, what it tracks is it tells us how many orders are getting added or subtracted at every price level. And this, again, this is constantly changing. The DOM is never static. It's always orders are getting added, subtracted, getting filled. So the numbers are going to be always moving, especially during high volatility periods like the New York Open, for example. Okay. Another way that we can look at the pulling and stacking is with what we call a heat map. So if I bring up right here, this is book map. Okay. A heat map shows us the historical pulling and stacking. So we have the same thing here. We have our limit orders to sell, our limit orders to buy. So this is basically a DOM, but we have the bid and the ask one on top of the other in the same column. And then we have price right over here. And with the heat map, what we're tracking is how the orders have historically shifted. So if I zoom in here a little bit, you can see right here, each one of these lines represents 1 minute in time, okay? And so you can see these bubbles are the execution. So green bubbles is more aggressive buying, red bubbles more aggressive selling. But for example, you can see this level here. If we look at 67.69, you'll notice that we had black right here, which black means that's the least amount of liquidity. But then we started getting a red highlight right here and then an orange. So that means at this level, orders started getting added here, and then they started pulling a little bit, but there's still a significant amount of orders resting here. With Bookmap, the darker the color is, and you can see by this scale here, the less liquidity. Then we go into the blues, whites, yellow, orange, and red. So red means that's the deepest liquidity that we have here on the screen at the moment, and black would be the lowest. And obviously all the settings can be changed. You can make this more or less pronounced, but I like to have it on the maximum because I just really I mostly care about looking at the highest levels highlighted. If I change this, you can see it's going to vary depending on what the price level is. I can zoom in and the colors are going to vary, but basically the advantage of a heat map over a DOM is that not only do you have the DOM, but you have the historical representation of how liquidity has shifted, okay? For example, here we had a little bit more liquidity and then it got pulled, and now there's not that much liquidity there. Here there was not that much liquidity, and then we started getting liquidity added here, as you can see, okay? So that is the advantage of a heat map that a DOM doesn't show us. Some other tools you can use, I've added here. This is a volume profile. So this is actually showing us the total executions that have gone through at every price level, okay? And you can see by the numbers here. And also you can see that we have it split between the green is going to be the executed buys and the red the executed sells. And then on the right side, I have a delta. So the delta is going to be the difference between the executed orders to buy minus executed orders to sell. So that's going to give us a reading of the market sentiment. So a red delta means more aggressive selling, and a green delta more aggressive buying, and it helps us judge the market sentiment, okay? Now, with the DOM helps us to see what the market sentiment is, and we can gauge that by how quickly orders are getting filled and how aggressively market is starting to move in one or the other direction. There's traders that have, trade for hundreds or thousands of hours just looking at the DOM, and they can basically spot patterns. For example, they can see when a level keeps getting reloaded with orders to buy or sell, meaning there's a large market participant that is looking to defend that level. So those are things that can provide good scalping opportunities. Okay. Now, DOM on its own is not a tool that I would use on its own to trade. I like to use it as a confluence, okay? Because with the DOM, you have things, for example, now with all the algorithmic trading, you have a lot of orders being added and subtracted, in fractions of a second, which add a lot of noise. So sometimes all the pulling and stacking of orders is just basically going to be confusing and not give you a clear read of what the market is intending to do. There's also what's called spoofing, which spoofing basically means when there's large orders to buy or sell that are placed, but they don't have the intention of getting actually filled. It's mostly an advertisement mechanism to attract price, because as you know, price will always be attracted to areas of high liquidity with large number of orders resting. So if someone is looking to move the market up, they may place a very large order to sell at a level above. So then market is going to tend to go towards that level to test that high liquidity level. But right before market actually touches the level to execute those orders, the orders are going to get pulled and they're not going to be executed, okay? So that's a practice that's technically not allowed, okay? Spoofing is not legal to do because it's a way of trying to manipulate the market by actually trying to make it seem like there's a level with a high amount of interest when in reality they don't want to execute those orders, okay? Now, with big institutions, and I have a video on this called the Iceberg orders. I'm going to link it down in the pinned comment. But big institutions, the way they'll trade is they'll use Iceberg orders, which are large orders that are split up into a bunch of different ones. So instead of placing, let's say right here, one huge order to buy 1,000 contracts, what they're going to do is they're going to have an algorithm that is going to be splitting that order into different tranches so that, let's say market comes down, starts filling some of those orders, then it'll pull up a little bit, and then it'll start reloading the next group of orders. It'll come back, fill those again, and as soon as price moves away, it'll refill, come retest, etc. So that way, the purpose of the Iceberg orders is to be able to get a good favorable average fill. Because if you put a huge order to buy or sell, when you start getting filled, you're inevitably going to move the market against you, and you're going to get what's called slippage, which basically means that your average execution is not going to be at the level that you. So for example, when we have big news events, it's very common to see that the liquidity is going to be start to get pulled out of the market. If you look at a DOM right before a big news event, for example, we're going to talk about this was during the last CPI that came out at 8:30 a.m. on September 11th for the data of August. Okay, CPI is one of the big market moving events in the equity futures world, and you're going to notice right before the number hits, markets will usually just start consolidating in a very tight range, and the DOM or the liquidity is going to dry up a lot, is going to go down a lot. And the second that the data hits, which as you can see happened right here on this 8:30 a.m. candle, this is a 5-minute chart on ES, then you get a huge injection of liquidity, algorithms starting to execute and place and pull and add a ton of orders, and then you're going to get these really violent, volatile moves because, again, there's not that many orders resting on the book. So the first move is always going to be a very violent move with a very big range. And then once the liquidity starts settling and all the activity starts settling again, then we start getting just back into the regular market activity. Well, in this case, until the New York Open at 9:30, where we get another huge injection of volatility and usually some big price movements, as we can see right here. Okay? But that is in a nutshell what a DOM or depth of market or price ladder is. It is going to show us the resting passive orders to buy and sell. And it's the bedrock for the relationship between market participants, passive and aggressive. It is going to help us to look at the market liquidity and the supply and demand dynamics in the market. Okay, that's pretty much it. Just an introductory video on this topic. I'm going to make more of this in the future. But again, hope you enjoyed it. Any questions, comments, leave them down below. And we'll talk again in the next video. Take care.